Hello, it's Happy Yields to Go Friday. Normalcy returns on Monday, and we'll send money to work again. The idea of turning money into personal investment capital is not new. Investing for income? Not a new concept either. Toronto, New York, or London, as one Baker Street detective told his retired friend once. Elementary, Watson. You know the method. Apply it. So, you find some bonds and blue-chip dividend stocks, add liquidity and diversification with ETFs, buy low, sell high, you monitor commissions and fees, keep an eye on winners, buy on dips, identify losers to get out as soon as possible. And you keep clipping coupons all along. But wait, there's more to it. If it's all so simple, why aren't we all winning? That is the question today. Time to go from search to discovery of Dr. Y's opposite George method. Stock exchanges have been around since the 17th century. A short 300 years later, by 1914 to be exact, London Stock Exchange traded 1/3 of all public capital in the world. Since then, the capital allocation gravity has shifted. Technology has made huge strides, but the way we invested stayed pretty much the same. Sure, we have keyboards, screens, smartphones, and an ever-expanding list of gadgets. Yet, what we do has not really changed. Experts and brokers in financial districts use their experience and skill sets going through something called sell-side research to try to pick tomorrow's winners. They decide what to buy and sell based on what happened yesterday and today's news. The problem lies in Mark Twain's observation. Forecasts are tricky, especially ones about the future. To make matters worse, there is no exception for brokers. They are human beings driven by emotions, motivated by compensation, susceptible to cognitive biases, and in a legally binding employment contract with large shareholder value, or to be more exact, profit margin-driven corporation, like the rest of us, they are prone to cognitive biases. Familiarity is sometimes mistaken for safety. Mistakes are difficult to admit because of the overconfidence bias, and unfortunately, there seems to be no safe escape route from FOMO. FOMO, or fear of missing out, contributed to Black Mondays and swans throughout history. It all starts with irrational exuberance. Investors and dealers alike are happily waltzing toward higher commissions, exotic alternative investments, and riskier rewards until the bubble finally bursts. Bear market bust follows. The herd stampedes right over the cliff as market prices crash. Income investors learn a bitter lesson. Say never again, and more often than not, add insult to injury by tossing away healthy income streams and missing eventual market price recovery. There has to be a better way that does not cost an arm and a leg, or in my case, a beak and a wing, and there is. Our method is so counterintuitive and contrarian that we call it the opposite George method. You don't have to announce yourself unemployed and living with your parents, but popularity is a counter-indicator in closed-end funds income investing. If you happen to be a CMO, no, not a chief marketing officer, a critical mind owner, you've got to ask yourself, what do efficient markets, described in 1952 by Nobel Prize winner Harry Markowitz, have to do with sitcoms? Well, just like the quirky New Yorker characters, CEFs are a bit of an anomaly. Why? Because 66 years after Markowitz, another American economist, Richard Thaler, got a Nobel Prize for advances in behavioral economics. And it all started with the publication of a series of articles called Anomalies. And one of the earliest ones discovered by Thaler were the workhorses of monthly incomes called closed-end funds. My human intelligence partner, Dr. Y, who according to Globe and Mail is a Canadian authority on the subject, deals with the anomaly by removing guesswork. That's the start. But buying dividends at discounts does way more by not blindly following emotions. If you want to do the opposite when people like George Costanza panic, it is not time to imitate a couch potato. You wake up, descend, and do some cherry picking. The low-hanging fruit, tomato or tomato, is clearly low. And by low, we mean cost of asset ownership. This is one of the parameters our system uses to screen 50 funds in my top 50 yields at discount universe. We know what MERs and other fees are, plus fund size, liquidity, yield, and most importantly, net asset value discount. Finally, the proverbial cherry on top. We plug in a statistical indicator called Z-score. It shows how unpopular or popular an asset class like government bonds, bank stocks, or listed blue-chip real estate is at any observation point. 52 times a year, around Friday market close, Pensionizer AI spots the popular funds. You can read that as expensive. If you do your due diligence and decide to sell, we suggest a replacement. The unpopular ones are discarded by poorly informed sellers. You repeat or develop your diligence procedures and scoop the ones ranked as 5 stars. Now, let's admit it, there's an elephant in the room. In near zero rates and global GDP growth, costs are everything. Net asset value discount, we'll explain that in excruciating detail, is a substantially bigger number than any MER saving you can think of. And while we're at it, let's not forget about the behavioral gap. That innocent-sounding name is connected to FOMO and describes the 3 to 5% annual negative difference in average returns for investors buying and selling funds compared to the aforementioned potatoes doing nothing. But doing nothing while automating and following the Z-score may do better. Without going into statistical jargon, let's just quote Morningstar. Z-score can help investors uncover truly undervalued and overvalued funds. That's right. Then why is it practically unknown in Canada? Who cares? Dividend detectives are standing by to fill in the gaps. We went beyond creating an index and launching an ETF. That's where the proverbial puck is. Where it goes is AI, IT, machine learning, and simple language processing. To continue the Sherlock Holmes analogy, Scotland Yard inspectors were not always competent in solving cases. If you'd like to consult about dividend discounts and the way to detect the best picks, our updates and best ideas will always be one click away. You will feel secure knowing that these easy-to-follow recommendations are a result of a rational calculation and not dictated by a need to earn a commission or some knee-jerk emotional reaction. Our services are set up to deliver the cost of service advantage and help in your DIY endeavors. We also follow the trends in digital advisor media regulations and compliance. In our opinion, there is no need to overpay for the perceived safety of big logos. The best platforms we've identified expose the clunky legacy systems for what they are, a money waste. Focus your needs and use AI IT to help you stay unpuzzled, unstressed, and in control. I'm Otto Yields. Intelligence is artificial, but the yields are real. Bring me your frequently asked but often ignored investment questions, and I shall un-FAQ them in no time at all.